Yo, what's going on, guys? We're actually going over the four dividend stocks that you saw on the thumbnail. So that includes Public Storage, NorFolk Southern, Vici Properties, and Starbucks Coffee. And we're going to be looking at the real numbers that you actually want to look at. And as dividend investors, this will give us an idea of, will there be stock price appreciation in the future? And how much dividend growth can the company actually afford? So I can't wait to share all my insight with you guys. And of course, this is all my opinion, not financial advice. And with that being said, don't forget to drop a like on the video. I really would appreciate it. The first stock we're actually going to be looking at is Vici Properties, ticker symbol VICI. And right now, even at this relatively high price, if we look at it, we scroll out to the 2019 chart, we're well above the 2019 level. And even at this level, right now, you get a 5.44% dividend yield. But over the past year, the stock price is relatively flat. But let's go deep dive into their financials. So first, we'll just quickly look at their dividend history. In 2020, it was 29 cents. Now it's 41. So that's some pretty good growth, but let's see how much more they can afford. So first off, I want to show you their total revenue growth. It's just insane. It's because they've been acquiring so many new assets. It's leading to a ton of revenue growth, and not just total revenue growth, but net income. But we want to look at the real number down here, which is the core FFO. But we'll look at that in a minute after we look at their balance sheet, which, as we can see, their assets 1 year ago, it was 37 billion. Now it's 42 billion. And if we compare this to 2020, they only had 17 billion dollars. So that kind of lines up with their total revenue for it to make more sense. But anyway, let's go look at their core FFO, which is roughly this number right here. And on a really bad quarter, they made $487 million. All right. So $487 million, and their dividend from that literally only cost $382 million. So they don't have that high of a AFFO payout ratio. And that's because if we head over here to their total common shares outstanding, well, yeah, they've been issuing a lot of shares because they've been acquiring new assets, but that's how REITs get their growth to them. So yeah, their total common shares outstanding are only up 5.58% year over year, which is technically the same as their dividend yield, but that's fine because I see a lot of growth to the future with Vici Properties, and I think the dividend is super safe. So if you want a safe, not financial advice, a safe 5.44% dividend yield, head over at Vici Properties, pick you up a few shares. And with that being said, let's actually dig into the next stock, which is ticker symbol SBUX or Starbucks Coffee. And right now, it's kind of at a deal if we look at it from 1 month ago. But check this out. Are they up from pre-pandemic? Yeah, they are up from pre-pandemic. They're right at that level, but their dividend yield is 2.43%. And I actually haven't looked at their dividend stats, so I'm gonna be doing this at the exact same time that you have. I haven't looked at their financials in a long time. So their net income. So remember, we value this completely differently than a REIT because REITs have to pay out their net income. So we're not going to look at the same metrics as Vici Properties because it's not the same thing. Anyway, look at this net income growth, $1.22 billion. If we zoom out, we can see that, yeah, that's definitely above 2019 levels, and it's very consistent. If we head to their assets to liabilities ratio, this is typical in the food industry, like Domino's Pizza, all look the same. Actually, Texas Roadhouse has a very good balance sheet, but this is typical. This isn't weird. This is completely normal, and I'll show you why when we look at their financials a little more. This is also their free cash flow right here. Check this out. They haven't been negative. Oh, the only time they were negative was in 2020 Q3. But anyway, let's take an average here. So on average, we can say, well, wow, look at first off, $1.94 billion in the most recent quarter. That's insane. But on a bad quarter, let's go off their worst quarter, $767 million. All right. Can they afford the dividend on that bad quarter? And the answer is yes. It's $607 million. So no matter what, their dividend, the 2.52% dividend, is safe. And if we scroll down to their total common shares outstanding, wow, they've actually been buying back their own shares. In the most recent quarter, they bought back almost $300 million worth of shares when normally, oh no, they consistently buy back shares. That's really good. So yeah, if we go to their total common shares outstanding, you're actually down 0.46% year over year. So you're not even being diluted as a shareholder. And now that they're making a lot more free cash flow, they're actually, I haven't looked into it, but I'm sure they have a really big stock buyback program, and they're going to continue to do this in the future. So their dividend seems safe. And I like the stock price appreciation with Starbucks because they're also buying back their own shares. And also, look at this. Right now, they're chilling on $3.55 billion of cash. If we zoom out, well, they had more back in 2019, 2020, but that's okay. But anyway, $3.55 billion of cash and total debt of $15 billion. So that's why their balance sheet looks a little iffy. But they can start paying down that debt anytime if they wanted to. And how much? And are they making money on their cash right now? So actually, they're not making money on their cash right now. Most companies with billions of dollars have them chilling in treasuries. Normally these 1 to 3 week treasuries. This company right here, since they have a lot of debt, they're actually paying an interest $113 million because they have a lot more debt than cash. But that's okay because they can, easily pay off the debt with time. But yeah, that's ticker symbol SBUX. It's probably the riskier stock on the list because I don't own Starbucks. But let's actually go to NorFolk Southern ticker symbol. Whoa, NFS. I forgot the ticker. NCS. Okay, hold up. All right, guys, I found the ticker. It was ticker symbol NSC. Took me a minute there, but anyway, look at how this one has done since that October low. It has done quite the rebound, just like REITs have. It's almost like followed REITs exactly, just like, well, that's because REITs follow TLT. But anyway, let's zoom out and look at how this stock is done. Remember, do you guys remember this company was in a lot of trouble? I think it was in October, last year of October, for the huge like oil spill in Ohio or something off a train. Anyway, we're gonna look past that because I feel like a lot of people already forget about it. But let's see. I bet they're gonna raise their dividend next quarter for sure, but I don't know how much. But I feel like they're gonna raise it because look, they're not just gonna not raise it every single year. They're gonna keep their dividend aristocrat status. But anyway, let's actually look at their numbers. So net income is down, but I'm sure that's due to lawsuits and a lot of the other railroad companies are seeing similar numbers. But we want to look at their free cash flow down here. So wow, it's even in the most recent quarter lower than the 2019 levels. I didn't even realize this. So wow, $660 million. So $660 million in free cash flow. See, I show you guys the real numbers. So you can do your own opinion after I show you this. So look, their dividend cost $305 million. So they can't afford it, which is good to see even on a bad quarter. And they've actually still been buying back stock every single quarter. They still bought $200 million back worth of shares in this quarter. And they need to start buying back a lot of shares because the stock is so discounted right now. But they used to buy back a ton of shares, $800 million a quarter. Well, let's look at their total common shares outstanding. Hey, you actually now own 2.32% more of the company than you did 1 year ago, and that you also got the 2.5% ish dividend at the same time. So that's a 5% return a year. Cash and equivalents right now, $1.51 billion. Hey, that's pretty good. And total debt of $16 billion. But these railroad stocks can get debt at super low rates because their income is so predictable. It's very, it's the railroads. Anyway, yeah, so the dividend seems safe. I think this one the railroads are going to be needed in the future. So I think the assets will just get better with time. So if you wanted to pick this one up at a discount now, could potentially be a good time to maybe start dollar cost averaging in. It could, drop back to the $200 level. That's not unrealistic. I would believe it. But hey, not financial advice. All right, guys. So here's the last stock, ticker symbol PSA or Public Storage, one of my favorite REITs of all time. And check out the dividend yield right now. It's 4.11%. And from pre pandemic, this one has appreciated a ton. Like it was, $200 and now it's 292, but it was at one point $380. And let me show you the dividend history on this one. So look at this. It's now $3 a share. And they did a special dividend of $13 at one point, back in 2022. But anyway, they rose the dividend from $2 to $3, which is a huge growth rate. I don't expect them to raise it again. I think they'll probably just keep it at $3 because they kept it at $2 for the longest time. Look at this, since 2017, they just kept their dividend at $2 a share per quarter. But hey, they might grow it because look at this. We're going to show you the real numbers. They can easily afford the dividend, which I'll show you. So here's their 2019 levels. They're definitely up since then because right now they're making on average. Yeah, look at this growth. That's crazy. 700 to $800 million a quarter. We'll just say $700 million on a bad quarter, and their dividend only cost $576 million. Why was it 2.7 billion right there? That's when they did this special dividend of $13. It was also because of an acquisition, but anyway, their dividend only cost $576 million. They can easily afford that. and only have debt of $9 billion. Why did it go up in the most recent quarter? They bought a ton of assets from Blackstone. I believe a bunch of self storage properties from Blackstone at a really good price. But yeah, cash and equivalents. Yeah, also self storage gets really good loans at really good rates because their income is also so predictable. And here is their total common shares outstanding. You've literally only been diluted 0.09% year over year. So literally no dilution. If you look at other REITs like Realty Income or Vici Properties that we looked at, the other ones in this video, they've been diluting you year over year, but Public Storage it doesn't. And that's what's unique about them. I really like them. I really love the self-storage industry. Let me know your thoughts. And yeah, hope you guys enjoyed the video. Don't forget to drop a like. It really does help me out a lot. Don't forget to check out my videos up here. I have a portfolio update and I don't know what the other video is, but make sure you check it out. Hope you guys have a great rest of your day.